When I scan the market, I'm always looking for relative strength. The reason that they're showing relative strength is because institutions are the people who are getting involved in these things. Once the technicals turn, you can now start to give yourself all the fundamental reasons why it's great.
And this is one of my favorite kind of entries, is these earnings gap ups.
Hello, and welcome to the Trader's Journey for Investors Underground. In this episode, it's an honor to get to share some of my recent conversations with Ariel Hernandez, also known as Real Simple Ariel. Ariel is highly regarded throughout the trading community for his swing trading and ability to spot inflow and outflow of money through sector rotation, group strength, and identifying changes in market cycle. Ariel is a true student of the game, and his passion for trading is undeniable. During this set of conversations, we'll discuss Ariel's early lessons in trading, where he finds edge in the markets, what his scanning and routine looks like, and just how important discipline and risk management is, not just for his trading, but yours as well. I hope you enjoyed these set of conversations. Ariel, thank you so much for being here.
Of course, Anthony.
Yeah.
Happy to be here.
Yeah, absolutely. I've been wanting to talk to you for a while. I've seen you on a couple of the other videos on Investors Underground channel. So really excited that you're here and we get to talk.
Yeah, absolutely. And honestly, I've had an awesome time doing those with Chris, whether it's Sunday Scan or, with Sam. He's honestly another great host too. And he's awesome. It's become a good friend of mine, doing these videos, and IU has become, like a home for me. So, it's great to just be able to do these videos and kind of get some content out to people as to what I'm doing and kind of how I view the markets.
Yeah, awesome. And I definitely want to dive into that during this episode. And I usually start out by asking, how did you first get interested in the stock market and trading? Because that's where it all begins, right?
Yeah. Well, as everybody knows, 2020 was COVID year. And there was so much going on within the markets. I mean, we were just coming out of this big correction, a violent correction at that. And some of my closest friends were actually doing really well in the markets. And I started to get interested in how it was that some of my friends were getting some of their success. And prior to that, I really didn't have any market knowledge other than just pick one of your favorite companies and hold them in perpetuity, right? Whenever you can invest. But then I started to realize that there's really a whole nother side of the market. And that's like the trader part of the market, right? Thinking about compounding those gains, getting in and out of positions, being in things for shorter periods of time. And I did start out as a day trader. And now I've transitioned into swing trading. But, just the allure of, and, you see big people posting 50,000, 100,000. I couldn't imagine anybody seeing that and not wanting that for themselves. And so obviously the allure of the fast pace, the being independent, working for yourself, working from home, making big money. And 2020 and 2021 really provided that. So that was really my attraction to the market, was finding something for myself. It's been a really crazy journey for myself, just kind of getting to where I am today. But I've loved every second of it and kind of the steps that we've had to take to get here. So.
Yeah. And 2020 was a huge change in the market, bringing a lot of opportunities for people to learn about the market, or experienced traders finding a lot of opportunities to take advantage of their expertise in the market. And so, what was that first year like for you? Do you remember some of the early lessons that you learned, some of your first trades? What was your first kind of taste of the market? Did you paper trade at first? Were you just trading live capital from day one? What was all of that like?
Yeah, so I won't actually ever forget it. I started trading a cash portfolio right away. And the problem really with 2020 and 2021 was it instilled a lot of bad lessons in everybody. There wasn't a dip you couldn't buy. There wasn't a stock not gapping up overnight. So that, especially for a new trader, you get to taste like really early success and do really well. But the reality is that didn't translate well into a rough market into 2022. So if you were a new trader like myself, you're taking bad habits with you into a now changing environment. And I didn't recognize the change into 2022. So just like everybody else who was a newer trader, effectively what they call a boom and bust trader, I also struggled in 2022. But it was the losing of capital that kind of took me away from day trading and said, what changes do I need to make to my own trading, my own learning, my own tool belt to adapt? But there's a lot of lessons to be learned in 2021. Some of my most successful trades were really sympathy plays, right? I wasn't so good at getting myself into the lead runner per se, the leading stock of a certain group, a certain sector, but it was recognizing that traders were always looking for that next one. So kind of allowing that lead runner to develop and go crazy because it would do it without me, right? I wasn't good enough to like get in and capture that move and hold it a GameStop, from 12 to 500, right? Like once it kind of had come up from the depths, it was then just now every time GameStop's moving, here comes your AMC, right? When you had your NFT names and you had TCAT going, here comes your DLPN. When you had Tesla going, here comes your Lucid and your Rivian and your Candy and your Solo. So it was like recognizing that sympathy play and not even trading the lead runner, but just leaving the lead runner on my screen and then trading that backup name. And that really was some of my more memorable trades because they were some of my most profitable. And really, the market was rewarding that, where in 2022, it stopped rewarding that. And so, again, a hard lesson to learn in real time, and even recognizing that stopped working, was kind of an eye opener for me. So,
and what was that experience like when you realized the market, or maybe you didn't realize that the market had shifted? And you felt some pain, some loss of capital. Do you remember that mindset, what you were feeling and how you got out of that?
Well, actually, what had ended up happening with me was I was trading on Charles Schwab at the time. It was TD Ameritrade. And I was really taking advantage of them providing liquidity. And so when a lead runner was moving, and then I was just like looking for that sympathy play, I was able to just take market orders and not really have to fill at a worse fill, buying the ask effectively. And then as market participants, because there was millions of us sitting at home with COVID money, the stocks would begin to kind of take off. And I had a better average with the market fill because they were providing liquidity. And then as soon as something would begin to move, I would almost begin to get out right away. Because if you had bigger size on or just big size for the portfolio you were trading, you're being rewarded instantly. So that was but then because I kept doing that and kept doing that and kept doing that, at the time, TD Ameritrade was like, okay, they gave me a call and they were like, this is toxic order flow and we don't like you taking this many market orders. And okay, that's fine. And they gave me a 2-week ban. Then they, let me back on their platform after my 2-week ban. And I didn't know another way to trade. So when TCAT would be running, I would be hammering away at the LPN. And eventually, they kicked me off their platform. So when I got over to another brokerage who wasn't providing midpoint liquidity, I started to struggle. And I was just like, they're not providing me that midpoint fill. They're not providing me that liquidity. And so when I would take 10,000 shares and I would pay 4 or 5 cents higher than what I would normally get on the market, I would instantly be red because if I wanted to get out, I would be basically marketing out and they would be filling me on the bid. So if there's a spread there, I'm basically getting in at the top and then looking at instant red and then getting out at the bottom if I wanted to get out. So that's when I kind of knew what I was doing in the past, although it felt like free money, and it kind of was, I needed to make big changes. And then that's when I really started to dive into some of the people that I appreciate most, even to this day, and started to tailor my trading around people who had decades long of success trading the markets. And I wasn't trying to invent anything by myself. I wasn't looking for some silver bullet that I was like, that's my aha moment, right? I just came up with this and, that's my edge, right? It was, what is the edge of the gentlemen or the women that came before me that allowed them to have 20 and 30 years of success that I can take from their game and apply it to what I can do. And then obviously through repetition, through studying historical chart patterns, technical chart patterns, how fundamentals align with that, did I really start to find my groove within the market. And even as early as 2022, when the market was difficult and I had already made that transition right around mid to 2021, I considered myself a swing trader. And I found some success swing trading energy stocks because that what was hot in 2022, in particular in the beginning. You know, you had the whole Russia invading Ukraine, energy prices going up. And so therefore oil stocks were going up. Okay. So I found that, and even sympathy plays worked then too, right? You had Indo going nuts, and then you had HUSA and INPP and OP and all these energy stocks following right behind the leaders, which was Exxon Mobil and Chevron, et cetera. And if you go more granular to small caps, you had Indo going from like 7 to 70, and then you had, you know, MXC and HUSA, INPP, et cetera. So some of the things that I did learn in 20 and 21 still worked in spurts, but when the market kind of turned and mega caps were getting beaten up, I was struggling, right? Buying breakouts wasn't working, and that was the only way I knew to enter trades. Buying earnings gap ups wasn't working because there were no great tech companies giving big earnings gap ups, right? That just wasn't the environment. And I didn't recognize it. So 2022, I still put my head down and continued to study some of the people who have had much longer longevity than I had at that point, and continued to kind of like tailor my trading to what they were doing and applying it to my own real-time trade.
How much could your trading improve if you had free access to all of the tools and resources inside Investors Underground? Well, we're giving away 2 weeks of free access to a listener of the podcast. Simply comment below with your biggest takeaway from the episode and then send an email to me, Anthony at investorsunderground.com. We'll be selecting a winner to have 2 free weeks of full access inside Investors Underground. You'll have access to the morning meetings, all of the tools, mentorship, and every other resource that Investors Underground members enjoy. We look forward to seeing you inside Investors Underground. So you get kicked off your broker, and so your strategy is now working, and you realize that you have to make some changes, which is definitely not a fun position to be in. You know, who were some of the names that you were learning from? What were some of the resources that you were, you know, either reading or watching to learn from and trying to adapt your strategy to, you know, evolve your trading so that you can get to that next step and eventually be where you are now?
First and foremost, everybody should read How to Make Money in Stocks by Bill O'Neill. It's like one of the godfathers of canceling trading. And then upon his shoulders, you have someone like a Mark Minervini. Upon his shoulders, you have a momentum master like Dan Zanger. If you're focused on the short side, which I started to be in 2022, someone like Nate at Investors Underground, right? Like to be able to capture that other. So well, if everything's going to be fading, you know, might as well go learn from some short sellers, what the heck's going on and how it works and what to do. So someone like Nate, some more shorting was from Gil Morales. And then, you know, everybody's favorite is, Christian Koulamagi, because he put himself out there in that Twitch world and he would just live stream himself. And every time he would talk, it's golden nuggets coming from his mouth. And you would be like, well, who did he learn from? And he would credit Dan Zanger, Mark Minervini, Pradeep, you know, Bondi. And it's like, you got these guys who have had 2 decades, 3 decades of success, you know, traded the boom and bust cycle, you know, in the late 90s and going into 2000. And they're still here today, 25, 20 years later. So I really just tried to take a little piece of using progressive exposure and volatility contraction patterns from Mark Minervini, learning what momentum charts look like from a Dan Zanger, you know, learning some shorting from Nate, and really just piecing it together and trying to trade in real time while still it being my only form of income, right? You know, 2020 and 2021 were so great that it allowed me to take a bit of a butt kicking in 22 to like really plant my feet firmly into what they were doing and then have it work for myself.
What were some of the changes that you made to your strategy? You know, what's that evolution look like? You know, what were you changing about your strategy and how do you trade today? What's your strategy today? You know, where do you find edge in the markets today where you might not have been finding it when you were struggling?
Yeah. first and foremost, one of the things that I've become most proficient at, in particular, the way I do it now, is I really want to look at the market kind of from a top-down approach. So I scan the market really well. And something that always stuck to me that Christian said is, where's money going? Where's money leaving? Right? When you do your homework at night, when the market is closed, right, and you've got a 90-day relative strength scan and you're just sifting through that, I'm saying to myself, what's been holding up best, right? What stocks have been, and in particular, at the ends of 22, right, I would start to see stocks that were really strong, and the market is still in this correction all the way into October. So I started to see stocks that were getting back above their 200-day while the market was still downtrending. I started to see some stocks, trying to make new highs, things like that. And so when I scan the market, I'm always looking for relative strength. The reason that they're showing relative strength is because institutions are the people who are getting involved in these things. And so that became like my first light bulb moment. And really, even going back to early 22, something that we spoke about privately off camera was, if you go back and you looked at the energy stocks, COP, the XLE, the ETF, the FANG, the XOM, the OXY, and you looked at these names and you realized from a technical perspective, they all look identical, right? They literally look identical, even leading up to their breakout on January 3rd of 22. And so that was kind of like my first light bulb moment that, okay, if we're looking at a particular group, are there other stocks within that group that look similar or that look strong? And then it became, okay, the market has 197 industry groups, and which ones are the strongest? I didn't want to apply my knowledge, because what Minervini and what Dan Zanger weren't talking about is the stock undervalued, right? They were like, what's holding up best, in particular when the market's going down? And the market was going down, ends of 21 and into 22, yet energy stocks were holding up the best. Okay, so why was that? Institutions are involved here. And so I was just trying to align myself with what they were doing. And one of the things that I learned from Mark, very brilliant, was using progressive exposure. So if I had a full cash portfolio and seeing a breakout that was taught by him, just a simple volatility contraction pattern, and you get that breakout, sizing in 10% of your portfolio on a breakout. And if that works, and then you do your homework at night and you find another really nice, good looking setup, and then that one works, now you're 20% invested. And then you do your homework at night and then you find another one and that one works. That's the market screaming to you that either you're on the right sector, the market's really healthy, and it continues to pull you in. It's attracting more and more of your money to get involved in the markets. And so those were like the little lessons that I took, from a Mark, or learning a beautiful technical pattern from Dan Zanger. And then on the flip side of that, if I notice the market going up, but you had stocks going down, they're telling you that they're relatively weak. Mm-hmm. So being able to play the short side and understanding what a failed to follow through setup looks like, or a stock trending below its 200, right? That's just institutions leaving. They're not supporting the stop. So I don't want to use my own brain and say that's gotten too cheap. I just want to say it's trending below the 200. If I want to be short, that's where I need to be.
Yeah. At this moment, I realized how powerful it would be if we can all sit down with Ariel at his desk so he could show us how he thinks about stocks and charts. And a week later, that's what I was able to do. So let's see that conversation now. I realized when we were speaking just how powerful it would be to get you back onto the screen so that we can talk about how you think about and search for sectors, groups, and market cycles. So I'm really excited to get to allow the audience to see how you look for these groups and ways to find the right stocks to buy.
Yeah, I think it's very important because, one of the things that I always say is, your prior leaders aren't always your upcoming leaders. So it is good to kind of, get to see exactly how it is that I like to scan the market, try and figure out where money's going, especially if you're a swing trader, right? I'm not looking at like past names and, after they have already made this huge extended run and then, they like crack. And then say to myself, oh, I'm just, those are the ones that are going to continue, and have this, because the reality is that institutions are the ones that move your stocks, and they also rotate their money from, theme to sector to industry group. And it'll be good to see how kind of I think about the market in that perspective and how it is that I find some of these names. And, I'm excited to kind of go through my process with everybody. So that should be a lot of fun.
So what does that process look like for you, Ariel?
Yeah. One of the very first things that I actually like to do is I just like to start, with a 3-month relative strength scan. So as I'm scanning and I look at this weekly of Visa, right, this thing has just been effectively a monster going back to 2011, right? This thing has just been in a very steady, there are periods where it pulls back, but it's, a move up, a little pull back, a move up, a little pull back, a strong move up. Now, even on the weekly, you could say, yes, this thing's getting quite up there. But then on the daily, how am I locating my personal setups? But I just kind of continue through my list, right? And I'll say over the last 90 days, while the market has been struggling, and the market for me, for the most part, is the QQQ, NASDAQ, or the S&P 500. But oftentimes, if I'm trading gold miners, the market for me will be the gold ETF, right? So how does this, down here when I talked about gold, how did gold look down here? Beautiful move up, long sideways base. If you zoomed out, it was a 10-year cup and handle. And then as soon as you started to break out at the ends of, February into first week of March, at this time when I'm seeing this breakout, right? I could have gone back and I remember the name, like AEM, and at the time it was also starting to get going, breaking above its own 200-day. So while gold is in a sustained uptrend, your gold miners are working well, right? And that's just kind of how I really like to work. But I'll just go through my 90-day relative strength scan and say to myself, is there a commonality between a few of these names? Right? Because that's what institutions are buying. So as I'm scanning, right, one of the second name on my screen was Visa. Here's Berkshire Hathaway, big breakout on the weekly, beautiful, consolidation and breakout on the daily. And I'll just keep going. You've got a Costco, a JP Morgan. So right off the bat, the first 4 names that I look at right at the top of my list, and I sort them by dollar volume, right? So I like to just know what's getting the most amount of money, because those are the most liquid things for institutions, right? So right off the bat, you've got a Visa, you've got a Berkshire Hathaway, and you've got a JP Morgan. So right off the bat, I know financials are, they're at the top of my screen, whether you're a credit card company, whether you're a conglomerate like Berkshire Hathaway, but they're an insurance/financial company, and JP Morgan, and then even MA, MasterCard, Citigroup, the first handful of stocks, within the first 15 names on my 90-day relative strength scan, I'm already noticing a pattern, right? Because I know some of these names off the top of my head. And the pattern is financial stocks, right? Anything to do with financials. So I can go on my ETF list and I say the XLF, which is the 4th most liquid at the moment, ETF, the Spider ETF. Well, this looks like it's about ready to make a new all-time high here, right? While the market's been quote unquote struggling, while your SPY, your Spider S&P 500, right, is struggling, right? Your XLF, your Spider financials looks pretty dang good from the ETF perspective, right? This really big move. And it's funny because you can look at XLF and say, well, when was it even better? Well, when it was even better was, when this thing pulled back and on the weekly held the 200 weekly. And some people love their trend line. So, okay, you draw a little trend line and it breaks out of your trend line in November of 2023. And then if we literally just go back and if you looked at your JP Morgan right around the exact same time, so if you were to say, in November's of 2023, your JP Morgan looked at the time fairly identical, where you've got this little downtrend break. Some people how you might draw it might be a little bit different for others, but effectively a very similar looking chart. And in November, it has that downtrend line break, and then it just takes off in a vertical rocket. And it looks a whole lot like your banking ETF. So first thing is first, I really like to just go through my 90-day relative strength scan, whether it's Visa, Berkshire, JP Morgan, MasterCard, Citigroup, and I could keep going down my list, and I'll see a few more financials. Right off the bat, I know financials are acting well, right? And then inversely to that, when I'm looking through my 90-day relative strength scan, something that I may not be seeing are semiconductors. So I'm not seeing semiconductors. And if I looked at the SMH, which is my semiconductor ETF, you would then quickly realize why none of the individual stocks are showing up on my 90-day relative strength scan, because this is your ETF in that time. This is what the daily looks like, right? It's not pushing out. There is no real strength there, right? And so what does that tell me about institutional interest and appetite for semiconductors, right? And AMD has lost 50+% of its value in the last year. NVIDIA is at the exact same prices as it was 12 months ago, right? Some stocks like AEHR have gone from 50 back to teens, right? Some stocks like AVGO and TSM are kind of just floating maybe near the highs, but not quite that well. So if you looked at TSM, right, it's had this pretty nasty move down, right? The DeepSeek move, the bounce back up, and the rollover, right? And I could pull up more stocks just like that. Your VSTs, your DeepSeek move, your bounce back up, and your rollover, right? Should your interest ever be in stocks that are all acting the same but yet rolling over? Or if you're a swing trader, should your interest be in stocks that are all near 52-week highs and your quote unquote underlying market has been pretty much struggling? Right now, there is rotation, and the reason that the S&P 500 can hold up so well, even despite semis doing nothing, is because banks are also a big portion of the S&P 500. Drug manufacturers are also a fairly decent portion of your S&P 500. So it's like you've got all these other sectors within the S&P 500 who are acting well. That when I just kind of go through my 90-day relative strength scan, I try to find a certain commonality. And another one that we talked about before we turned on the cameras was, you can look at an AbbVie. Well, an AbbVie here is, and I'll just pin this, an AbbVie here is at an all-time high, right? It gaps up on earnings, pulls back, has a kind of a down day on its earnings day, instantly reclaims that move, right? Here's your earnings gap up. So it's still a green day, even though it's a red candle. Right, it was kind of sold off all day on earnings, but then instantly bought back up and then just continues to trend against its 10-day period moving average. Right, and if we looked even further, right, and on these scans, here's Johnson & Johnson right underneath it. Right, you get Johnson & Johnson reclaiming its 200-day moving average and continuing higher. Right, and then same thing. If we go a little bit further down on the scan, we're going to see, a Vertex Labs, right, reclaiming its 200-day moving average. You're going to see an Abbott Labs, bouncing right off the 200-day good earnings and continuing to push higher. So while other parts of the market are doing nothing, there are stocks within the group or within the market doing really, really, really well. And my own scans are pulling these things right up to the surface for me because they've got 90 days worth of relative strength to everything else. And then I just sort them by how liquid they are. Right? The more liquid they are, the more institutions can put to work there. And that doesn't mean that those are the names I need to own. Those are the sectors I need to focus on.
And when would be the best time, in your opinion, to be buying stocks?
Yeah, without question, the best time to buy stocks is after a market correction. Now, what stocks do you want to buy? You want to buy stocks that are already breaking out or near 52-week high. 52-week highs and all-time highs is not bearish at all. But if stocks are doing that when the market is going down, it's even more of an eye-opener. Like things that gap up on good earnings when the market's pulling back, or things that hit 52-week highs when the market is pulling back, is such a powerful visual tool to see. And a great example that I always think of is, here's a great example, was Netflix. So this would have been in ends of October of 2023. The market was in a 10% correction, and I guess it's good to see this from the market perspective. So here we are. This market, this is your high in the summer, basically July, and you've got these like three little clean waves down. Right? Three little oscillations lower on the daily. 1, 2, 3. Okay, beautiful. And now for people who are unaware, a market follow through day is the market will give you a bottom right down here, but you don't know that that's the bottom, right? Then you can get 1 day of a short covering, 2 days of short covering. By day 3 or day 4, you should see an increase in volume, right? And that is buyers then coming in, right? It's not just like less and less short sellers covering their position up, right? It's you get this 1 day, here's your bottom, 2 is your second day, you don't know that this is going to be your low, your next day, your third day, and then an increase in volume, right? So on November 1st, I view that as a follow through day. Even better was on the second when here's a gap up overnight over the 200 and another big green day, right? And then another gap up and up now above the 50. Now this is a V-shaped recovery, but down on the first, you should have a few stocks potentially on radar that are acting well. If you do, when the market gives you that follow through day after a correction, 10% correction, do you have a few stocks that are buyable? And I love this as an example because the best time to buy stocks is after a correction. And if you looked at, for instance, Netflix, what did Netflix do? It was going down with the market while it's doing its 10% correction, and it gaps up on earnings, right? And this earnings day is October 19th. So the market still goes lower for another 10 days effectively. And what does Netflix do during that time? Does Netflix go lower while the market's going lower? Does Netflix go and see new lows like the market? No, it does not. Netflix goes sideways. And when you get to the market low, which is the 27th, here's that little pullback on the 27th. You get a few little green days in a row, just like the market. And the market on November 1st, in my opinion, was your follow through day. Coincidentally, this is an inside day, a very tight, narrow range day. So in the back of my mind, I go, okay, this thing has a gap up on earnings. It proceeds to go sideways for 2 weeks or 10 days while the market still trickles lower. Right? That's strength in and of its own. It's not doing what the market's doing anymore, which is going to see new lows. In fact, we're back up above the 200. And for anybody knows, stocks above the 200 is not bearish, it's bullish, right? It's just what's it doing over the last year, right? Tried to break the 200 and nope, it gapped right back up above on good earnings, right? It tried to come back into the 50-day moving average and wicked right back off. Tried to come back into the 50-day moving average and came right back off. Right? And then it has a really tight day on October 31st. And the very next day, the day the market gives you a follow through day, Netflix should have already been on your radar from the gap up. Another great example was ANET right around this time. So it comes back down. It's still already above the 200 day. Why? Because this thing was already in a nice steady uptrend with the 200 day having turned up. And then what do you get? You get this kind of a nasty move down before earnings, but then on earnings reclaims all of it, right? And effectively at that time, if we were looking at this, here's your highs for this ANET. And what did it do on earnings? It made a new 52-week high, right? And this is on October 31st, the day before the market gave you a follow-through day. So effectively, you now have stocks similar to some of these pharma names now hitting new 52-week or all-time highs when the market is potentially a Friday is the day you were like, hey, that feels like it could have been a turn. Okay, that's fine. And now you've got stocks already hitting 52-week or all-time highs. Here's an ANET, right? And what does ANET do? Well, it goes from, $50, $49 at the time and just trends all the way to 130. So it does 100% plus move for you. Netflix does 100% plus move for you. Now, again, would you have been knocked out a few times along the way and maybe had to rebuy it? Yes, right? But it's a good example of spotting that relative strength and the best time being after a correction to buy something. Another really good example, and we can just give one more, is this Deckers, right? So we go back to this October date, right? And here you go. You've got the market put in a low on the 27th, Anthony. On the 27th, the day the market put in a low, look at this huge earnings gap up. And this is one of my favorite kind of entries, is these earnings gap ups. If you buy a 5-minute opening range break on something like DEC, right? You're buying this thing at, $90. And what does debt go on to do for you? Well, just, and again, when stocks gap up on earnings, very good. When stocks gap down on earnings, very bad. Deck is a perfect example of that, right? And recently, you had this nasty earnings gap down, and what's it been doing ever since? And over here, you had this beautiful earnings gap up, and what did it do ever since? Right? So you get, before the market even gives you a follow through day, Anthony, you get this beautiful gap up, and then it just continues to grind higher. By the time you get to 11.1, right? This thing just continues and continues and continues. Why is that? Because it was already at a new all-time high. The stock market was down 10%. The stock market gives you a follow-through day, which it's like, a good analogy is like, you put your hands on a beach ball and you hold it underwater, right? That's the market. And then you take your hands off and that beach ball pops up, right? There are stocks that start to pop up before the market takes its hands off. That's how powerful they are. But when the market's hands come off, anything that wanted to pop up to the surface does so, right? And it does so right before or on the follow through day or immediately after, right? Once you start to get the market ripping and roaring for 4, 5, 6 weeks, and I've got some good examples for that too, those setups are no longer as powerful, because now you're buying something in a more extended market versus buying something immediately after a correction. And I'll just give one quick example. I remember this ESTC, right? So the market gives you a follow through day right here on 11.1. So what does this ESTC proceed to do? Right? It just finishes consolidating. Right? It has this gap up on earnings, but then just goes sideways for a really long time. It gaps up in December. So a month after, on December 1st, a month after the market gave you a follow through day, right? But then what does ESTC really do? It just kind of lingers and chops. And if you bought it on its earnings gap up, it really, fine 20% move, but then you get quickly knocked out, and it just chops and chops and chops and chops. Why? Because buying something immediately after the market follow through day or on the market follow through day and noticing its strength before the market has a follow through day are all very important factors as to what your newest leaders can be, which is why I love corrections, which is why when I see the NASDAQ or I see the S&P 500 pull back, how it has recently, my eyes start to say, what are the things that are holding up best? It's financials, it's some REITs, it's some pharma names, it's not semiconductors, it's not nuclear names, it's not AI data center names. That's the reality, but people are so in love with what has happened in the past that they think that that's what's going to continue to happen in the future. And that's not how that works, and we'll touch upon here in a few minutes other groups that have moved together just to really get a good visual of groups really do move together. So when we see a bunch of financials holding up well together, or when we see a bunch of pharma names holding up well together, there is a reason for that. And when no semiconductors show up on my screen, there is a reason for that. And I'm not here to argue and look for the reasons, right? I forget who said it, but somebody said, if you go outside and it's 20 degrees outside, do you go looking for the reasons of why it's 20 degrees outside, or do you just put a sweater on? Right? I forget exactly who it was that said that. And I was just like, he's right. I don't want to look for I don't need to know the every why as to I don't need to know the why the market's selling off, right? It's cold outside. I put a sweater on. The market's selling off. I'm maybe not in those positions anymore. And I go looking for that sweater to put on, that relative strength. So having to know the why of everything is not the best way sometimes, right? It's just, this is what it is. And that's the reality. Let me go get my sweater.
Yeah. Yeah. And how do you think about identifying different market cycles or shifts in market cycles?
Yeah, I think just very easily is just through your ETFs, right? It's like not everything on my ETF list is going to look good, right? It's just the reality. We can look at SMH and just say, this is super choppy. Could it break to the upside of the range? It could, But all this thing has done is just had an increase in volume every time it goes down. It's had a decrease in volume every time it goes up. Every time it tries to breach the upper half of this range, it fails to break out, fail to break out, fail to break out, fail to break. And now you break below the 200, right? It's just your own eyeballs have to, and if you just stick a 200-day moving average on something and you objectively say above it is good, below it is bad, and you don't argue with it, because if you studied a gazillion charts in your life, you would say, how do stocks act above the 200-day moving average? Well, you could look at very simply in NVIDIA, and you can come all the way back over here. Coincidentally, this is the area that I bought it, and it breaks over its 200-day, and we're talking in January of 23, right? This thing is, the ends of or the beginnings of 2023, and this thing doesn't even with the 200-day moving average again until recently. Right now, it's tried to reclaim it here again most recently, and this is just from a EMA perspective, but your SMA is still a little bit higher at 126. But your EMAs effectively, it reclaimed a 200 EMA, but below your 200 SMA, it's still below that level. And it'll be easier to see on this side because I do keep SMAs over here. And so just very objectively, just throw a lagging moving average on there. It's lagging for a reason. Price is good above, it's bad below. And when you scan through, 20 other stocks within the group, you can see some are okay, some are terrible, some are okay, some are terrible. Inversely, financials since March of 2023, they've almost all been really good, right? We had the banking crisis where Silicon Valley Bank blew out, and you had like these catastrophes in these banking names. Well, like you just said, buy when there's blood in the streets, right? At that time, that's not normally how I like to buy a swing setup per se, but that is where stocks will bottom, is when it's the absolute most catastrophe for that group. And that's what it was. And then they bottom, and then they, finally got accumulated, went back up. They had a nice little tight setup, and this banking crisis happened in March, and I was looking at JP Morgan, and I thought it looked good in November, right? So you're talking 7-8 months later of them being accumulated by institutions. And by the way, you're not late to JP Morgan if you buy it in November, right? It then went on to go on for another year plus. So it's not like you have to be the first in the pool. So at least from my perspective. And then again, on the inverse side of this, you get an NVIDIA kind of starting to, it broke above its 200-day way down here in the $16 pre-split or post-split. And then, now all of a sudden you're kind of starting to live below the 200, over the last few weeks. And that's not good. Right? I'm not saying that NVIDIA is going to die, but if it established itself below the 200, I can just step back and say, NVIDIA being your biggest semi is starting to live below the 200. I don't want to be involved in those, right? I want to be involved in the things that are above their 200, and kind of understanding that everything has its turn under the sun, right? And I remember, we talked about this with energy names, right? It was that moment where I saw those energy names and I realized how similar they all looked, that I was just like, okay, they look similar because institutions are buying them. And then these semiconductors look similar, AKA breaking below their 200, because institutions are selling them. And try to not argue around those lines too much.
I've heard you say, birds of a feather
flock together.
And it definitely makes sense when you see it on the chart and you're able to look at all of these different names. And speaking of the chart, while we're looking at the chart, I'm seeing a lot of lines on your charts, and I'm sure people are wondering, yes, there's the 200-day, yes, there's the 50, there's the golden crossover, maybe some people might be looking at, but I also noticed some other lines. So what are some of the technical indicators that you look at or keep on your charts when you're looking to maybe get into a stock or maybe to even sell something?
Yeah. So actually, something like this is just a simple flat base, right? Where it makes this big gap up on earnings and then, pushes a little bit higher, but then proceeds to go sideways for 5 months. And right before we break out, you're building these higher lows where every time it comes down, it's not coming lower, right? Every time it comes down, it's being supported at a new spot, and you're coming right up to this breakout area. Now, I remember this day right in here, and it was getting back up above the 20 and the 10-day, and the moving averages are very, very tight, meaning NVIDIA moves, about 4% per day. And at this point here, we were 2.5% above its 50-day moving average. So relatively tight, right? We're only like one average daily range away from the 50. And I remember I bought this thing on 1.5, and yes, you're still within the range. But then I ended up buying some more on 1.8 as it was breaking the range. And at the time it was like $492 or $494, and then buying some more for the breakout of 500, right? And what does NVIDIA do by that day's end? An increase in volume, a big push from 49 to 52, and then you never turn around. For me, I like to wait for 3 to 5 day pushes and then trim some into strength and then just trail the rest on this ascending 20-day, right? So as long as it's trading above the 20-day, I don't care what it's doing. If a stock trends for a month effectively above my 20-day and has given me a 20-30% cushion, and the 50-day has caught up to my spot, then I like to use the 50-day, right? A stock has to earn the right for me to hold it longer. If you're a a faster name, like 8, 10, 12 ADR, like one of these quantum names most recently, right? I don't want to give it wiggle room. Like even, HIMS, I was in HIMS, right? Once this thing breaks out, and I mentioned it in IU as a potential swing setup, I thought that this breakout over $29 looked pretty good, right? You kind of have this little flat base. So above 29 and above all of its key moving averages, above the 50, above the 20, moving averages are very, very, very tight. So I'm not coming into HIMS up here and being like, oh, I got to own it at 50 when it's, at this point, it's 50% away from its 50-day moving average, right? I don't want to own it when it's 50% above its 50-day moving average. I was looking to buy it, when at the time, we're looking at 7%, 6% away from its 50-day moving average. So if I'm going to jump out of a window, I want to jump out of the first floor, right? That's kind of what stock trading is. It's such a place where there's so much uncertainty that, yes, a chart may look good from a technical perspective, but if I'm going to try that setup and I'm going to jump out of a window and take a leap of faith, I want to know that I'm on the first floor in case I'm wrong, right? And I don't break any ankles. But if I jump off the 12th floor, right, I might break my neck. And so there is a difference, or my likelihood of success of landing safely isn't so good. And so again, even with HIMS, I bought some at 29. I sold some off at 37. So literally on this day here, you got this fairly big push. And then we started to get a little extended even from the 5-day, the 10-day. And I was like, all right, let me take some off. Did I know it was going to go to 70? Of course not. Otherwise, I would have held the whole thing, right? But my crystal ball doesn't work that well. And so I take some off at 37 and I allow the rest of it to work. And then the way I like to manage my trades, and I've mentioned this in other videos with Sam before, is when something gets extended from the 50-day moving average, and for instance, HIMS moves 12% per day. So when HIMS is 60% away from its 50-day moving average, right? I know that we're 5 times its average daily range away from the 50, right? The further you get away from the 50, so like at these highs, you're 118% away from highs from the 50-day moving average. You're almost, 12 or 10, 11 times its average daily range away from the 50. I know that into these pushes, I should actually be trimming and definitely not consider buying. I don't like to buy stocks more than 4 times their average daily range away from their 50, because then there's not enough meat on the bone. And that is one of the things that I like to consider when I buy anything. Am I buying something that's extended, right? Just because it's strong, that's fine. But if it's extended, it's no good. You need to recognize that strength before it gets extended. And, even relating to a simple chart like AbbVie, it gaps up on earnings. And those are the only exceptions where you can buy something that gets a little extended from the 50, because institutions are building positions for a few months. But even something like AbbVie, if you're buying a break over, this little high of this earnings day, and you're buying on any one of these days here, you're looking at something that's only 6% away from its 50-day. Well, it moves 2.5% a day. So it's like 2.5 or 2.25 times its average daily range from the 50. It's not very extended at all, right? So it's very safe to buy this thing on 212 or to buy this thing on 218 as it's finding support and rise. It has a rising 10-day, a rising 200-day. And it's not the only stock within the group at the time. I noticed, and I mentioned it on Twitter, Johnson & Johnson looked good. Abbott Labs look good. Now you got VRTX looking good. You've got like all the evidence there that you need that these things are going down while the market, the S&P 500 is just chopping around. Institutions are telling you something by that, whether they're defensive stocks to the market or they're not, or whatever, come up with all the gazillion reasons you need to tell yourself as to why they're going up. The fact is that they're going up, and they're going up in a market that's going down. There's a reason for that. And when the market releases its pressure, when it takes its hands off, right now, all of a sudden, AbbVie isn't fighting the market at all, right? Johnson & Johnson won't be fighting the market. Abbott Labs won't be fighting the market, because if Friday was your low, well, look at this beautiful day that AbbVie has on a pickup in volume. Now, are we starting to, if you bought this thing down here and you're starting to get, 12% extended from its 50-day, right? Now, do you start to say to yourself, hey, when this thing gets 16, 18%, something like that, do I need to start to consider to peel some off? Yes. And then know that, hey, this thing could very well go sideways, and I don't want to hang out with my full position in something like that. So it's kind of the way I think about it.
Yeah, no, thank you very much. I appreciate, because I think it's important for listeners to know, where you're thinking about taking those profits, because especially in the world of social media today, you hear everybody talking about things are going to go to the moon, or this is the next, big thing. And it's really easy to hear way too often that you just hold something forever.
Well, Anthony, that sounds like quantum computing, right? Just a few months ago, they were the new and biggest and hottest and the greatest things ever, the newest. I mean, I found it laughable. And again, this isn't to disrespect anybody, but anybody who thinks that a company like an IONQ who doesn't make real revenue is going to be the next NVIDIA, it's like the book, The 48 Laws of Power. You're playing on people's fantasies, right? And so it sounds good, right? It's like, and now if I talk about AMC, for instance, there are so many people who were wrong on that, right? Like, and they bought it in the 40s and the 50s and the 60s and the 70s. And then, they've done a bunch of splits since then. But, and then once it starts, getting crushed and it's down 50%, if I start talking about institutions are manipulating it and it's going back to the moon and it's going to be a $5,000 stock, and I'm playing on people's fantasies. Those are fantasies. That's not reality. Reality says that market institutions rotate their money from one place to the next, to the next, to the next, to the next, and everything has their chance under the sun. That's not to say that stocks can't come back to life. But if, Anthony, you've traded long enough, you remember the weed stocks in 2021. You remember the shippers with dries and tops and ship, right? You remember even these quantum stocks with now Rigetti and IONQ and QUBT. A stock goes from 1 to 27. A stock goes from 80 cents to 20 in 2 months, right? Even these nuclear names, like I don't hate on Sam Altman just to hate on Sam Altman, but he is like the golden child of Wall Street, kind of, in a way, with OpenAI and now being invested into Oklo and, being part of Oklo. The reality is that they don't make any money. So if you don't make any money, why would the institutional appetite stay there? One of the reasons that institutional appetite stick around is because a company pays a dividend, and they're dividend-only hedge funds that they can only buy if they pay a dividend. Or they make money and a company can buy back shares over time, right? And so your piece of the pie, if you hold it for 20 years, only gets bigger because there's less shares in the market, because the company has bought those shares off the open market. So it's like, if you make money, great. If you do not, you get a run, it dies off. But if you're a great company like an AbbVie who does make money, who does pay a dividend, well, then what ends up happening? They make a run, they consolidate for a really long time, and then they continue higher. And then they consolidate again, and then they continue higher. And they consolidate some more. It's like why a company like O'Reilly Auto Parts or Auto Parts or even like a Old Dominion Freightliner, right? It doesn't look good right now, right? This is very choppy, very ugly, very whatever. But if you looked at like a 20-year monthly chart and you looked at Old Dominion, this thing has effectively been going higher for the last 17 years, right? But you get this extremely large move up and now you're just kind of going sideways, even on a monthly chart, right? But that's exactly what leading charts do. They may be out of favor in some moments versus others, but the reality is that money goes into a sector and it makes a nice, beautiful run. Nobody knows how long it's going to go for. And then they sell off. And then they get accumulated, they go for a run. Nobody knows how long they're going to go for. And then they might go sideways. And it just happens over and over and over. But majority of people, 90% of people who tend to lose in the market, in particular retail, they buy when things are too euphoric. They sell when things have gotten really bad, right? Instead of buying things as they're coming out of a tight consolidation, first they give you that little leg higher, and then they consolidate quickly for a few weeks. And then you're going to see the evidence in the other stocks within the group. And this might be a good time to maybe even look at a few of those energy names. And that was like my aha moment with how these things move.
Thank you so much. Yeah. And I think it's important for people to understand that, in trading, the profit is only hypothetical until you take the actual profit. And
that's right.
To your point, we've lived through so many of those sort of temporal darling stocks. It might be Sam Altman today, but not too long ago, it was Sam Bankman-Fried and, was on the cover of magazines. Or to your point with, the marijuana stocks, Canopy Growth was going up until the point that it wasn't anymore. Or
Tilray, another one.
Yeah.
Kern, another one.
Yeah.
And they all do the same. And even, when we talked about the meme stocks, right? Yep. Or the NFT names, right? It was TCAT and DLPN, or when it was EVs, it was your Tesla's your leader, and you've got Rivian right behind it and Lucid right behind it. And then you've got companies who've gone bankrupt, right? Like your terrible ones, your Mullins, your Fiskars, right? It's like they're not even around. But in a very hot environment where you have your leaders, right? It's like Tesla is your leader, right? You then get your mid caps that follow, your Rivian and your Lucid, and they're still around, but their price doesn't act as well, especially when a Tesla hasn't acted all that great for the last few years either. In spurts, it's done all right, and Tesla even did all right, when Trump got inaugurated. But the reality is that it's a car company whose margins are decreasing and they've got a lot of competition and they don't do humanoid robots yet. So price is down almost 50%, right? All while the market's down 5%. So it's like you have to have something that gets you out of these extended moves. You have to have something that gets you out of a breakdown because you can't live in fantasy land. Now, if things want to continue higher and just trend above their 50-day, God bless. And you can be in that. But when they break a 50-day or they break a 200-day or they break a 20-day, depending on your entry, your risk tolerance, your thesis for it, your position sizing, all these little nuances, then what moving average am I using? But once it starts to break below, you don't argue with it. It's a lagging indicator to begin with, right? So now price is broken below a lagging indicator. You've already now held a chunky pullback, right? So, and again, those profits aren't yours until you take some off the table. So having something in place to also allow you to trim into that strength, just to not be holding something for a third, right? If I just held HIMS and said, I'm going to hold it on the 20, so I have to hold it a 40% pullback without getting rid of any before I finally get rid of some? No. You got to have something in place that allows you to take some off the table before a 40% pullback.
Yeah.
So very important.
Absolutely. And that's one of the things that we touched on a little bit in person in New Hampshire was, this idea of risk management, know when to pay yourself, when to trim, and then, keep your risk management in check. And so I definitely wanted to, talk a little bit about that just to, kind of highlight again some of that discussion. How important is risk management for you and, your future in trading, but also to the listeners as well?
Yeah. I mean, it's everything. For a swing trader, it is by far the most important part, because as a swing trader, I'm wrong 70% of the time, right? It's not that I can't find the groups where money is going, but it's I'm trying to hold this thing for a bigger picture move at the very minimum 3 to 5 days so that I can catch some of that momentum burst, right? It's like I like to look for that quote unquote coiled spring, right? So that when I buy it coming out of that tightness, I can get that 3 to 5 days, pay myself into that, and then allow those now to what were tight moving averages to be ascending, and then just use them as my lagging indicators for how extended something's gotten away from that moving average. And then when I'm down to my final piece, allow it to just surf or use that moving average to say, hey, if we break below the 50, I'm done with it, right? And, there's a chart that I own now. I own Toast, right? This is one of the names that I own, right? I bought this thing as it was getting back above the 50-day moving average. And it worked beautifully the very next day. And I like Toast. I like them as a business. We were in New Hampshire and I realized how the East Coast toast is everywhere. Right. And then, I don't know how it is over by you, but even here in, Illinois, they're growing like a weed. So I like them as a business. I've known them as a business for a while, and I size myself in right. And then what happens? I get the steady little trend away from my average. I get a gap up on earnings. Right. And now all of a sudden, I love the business. So I say to myself, I haven't trimmed at all, but I won't be leaving until it closes below the 200-day. Right. And so now if you look at it, right, it's just building its own new base. But even from my entry, which is sub 25, and the 200-day is now at 31, but price is at 38, almost $39. I don't care what it does, as long as I'm positioned well so that I know no matter what it does, as long as it's closing above the 200-day, it can do whatever it pleases, right? But I'm wrong. You're wrong so often in swing trading because you're looking for that, not that instant gratification. You're looking for that bigger move, right? And it's a few of those Rocket Labs. It's a few of the Toasts. It's a few of the Alibabas. It's a couple of Hims that I might catch a year that make the entirety of my year, right? I only need 10, 12, 15, 20 trades that go in my favor to be a really, really great year. Because when I'm wrong, like buying an AbbVie where I'm risking, 2% of a drop is my stop. But, I could have 20% of my portfolio in there or 10% of my portfolio in there. If I'm risking, even if I had 100% of my portfolio in there, if I'm wrong, I lose 2%, right? It's not like you couldn't overcome that. If you had 50% of your portfolio in there, you'd be losing 1%, right? So it's like, if you size properly, and most of my positions dependent on average daily range, I typically like to do 10 to 15 to 20% on the biggest, right? So like on something like an NVIDIA, it was even a little bit bigger because I bought it in 2 pieces and my risk was really, really tight. So like I remember I had like a $496 average and I was risking like $3 a share on the day that I bought on a 400 and some odd dollar stock. So it's like you're risking 1.5%, right? Upon your entry. Like if, and then it goes on to work. And then I take another entry the next day when it's breaking out of the big base. And then it really pushes away from my average, right? It's like at that point, I've got like a 497 average. And by the day's end, it's at 515. My stop could go to flat, right? It doesn't even have to be at the lows of a pivot anymore. And that is one of the things that I think is really important. As a swing trader, I take a lot of flat trades. I take a lot of small little red trades. I take a lot of small little green trades, but I'm always working to improve my worst case scenario. If the stock gives me that 3-day push, I trim a little piece into that, a third, a half, right? Dependent on how fast it's moved away from my average. And then I just keep the rest on the ascending daily moving average and my job is done.
If you're looking for ways to take your trading to the next level, Investors Underground has something to offer. You'll have access to courses and mentors to learn from, some of the best technology available for scanning stocks and breaking news, and access to the chat rooms where you'll find a vibrant community of focused traders who share their trade ideas in real time each day. Investors Underground members have access to the morning broadcast where the IU moderators share their trade ideas for the day ahead during the pre-market session. Members have access to the midday study sessions with Stan, the midweek study sessions with Sam, webinars, moderator watch lists, and all the tools and resources that Investors Underground has to offer. Listeners of the Trader's Journey can access exclusive membership deals available at investorsunderground.com/journey. And now back to our in-person interview with Ariel Hernandez. How much do you focus on the fundamentals? Because you might find, like you mentioned, a stock that technically looks like it's in a good position. Maybe you're thinking about trading it. If something looks good at a technical level, do you then go look at the fundamentals and try to find out if it's the best in terms of fundamentals within that group? How much do you factor in fundamentals with the technical setup that a stock is showing you?
Fundamentals are that thing that make you patient within a good looking technical chart, right? The institutions are what's driving it. So if technicals or if fundamentals get better over the course of a year, right? Institutions are very bright people, pay people millions of dollars to do this sort of research, and they could see the growth coming for this company, and fundamentals change quarter over quarter over quarter as companies report earnings. So if a company or if a stock is not acting well on a technical level, then I don't care about fundamentals at all. That's diluting my brain into believing that I think that these fundamentals are good, when the reality is that they might be good, but institutions don't care about that right now. Hence the reason we don't have a good technical pattern, or we're in a bad environment, right? We're in a bear market, and technical or fundamentals might be great, but the technicals look bad for a reason. Versus you have a strong market, right? You just look at the market objective and say, is the 200-day sloping up or is it not? And then is this stock in a top 40 group or is it not? And then once you have a really clean technical pattern and the stock begins to push out, then all of a sudden I love those fundamentals because it's that thing that makes me patient within a beautiful looking chart. Well, it looks great because institutions are buying it, but it's now when you say to yourself, well, they've got accelerating earnings and sales. They're in a top 40 group and they've got that nice technical pattern, and they're going to have a 50 billion or 20 billion or 100 billion in NVIDIA's case of free cash flow. So if that's the case, right, I just want to sit there and do nothing and let's trail a lagging moving average and see how far institutions want to take this thing, right? Because once I take my position, I'm not buying more and buying more and buying more like they are quarter over quarter over quarter. I take my good entry and I just sit tight and I manage my risk from my good entry. But fundamentals to me do not matter at all in a downtrending chart. A lot of great companies have good fundamentals, but they're downtrending, right? Some home builders might actually have free cash flow, or we can talk about the Chinese stocks. Some of them trade at low PEs and tons of cash on the books, have a third of their market cap in cash. All those things might be like, well, that's attractive to an institution, but for a long period of time, they were unloved until recently, right? And then once the technicals turn, you can now start to give yourself all the fundamental reasons why it's great. And on the flip side of that, you could have small cap companies who don't have fundamentals at all, and they just strictly fit into the momentum category. If that's what you like to trade, and you're not going to marry this thing while the fundamentals are quote unquote bad, that's okay. Trade it from just a technical perspective because they're in a good group and they're got hot momentum. So that's how I view it with fundamentals.
Yeah, I think that's helpful. From your strategy perspective, say you find a stock that looks good. You are thinking about entering the position. What's that process look like? Or is there a particular catalyst or news that you're hoping for? Is there a particular gap up that maybe you're looking for in that name or in that group, in that sector? Can you walk me through sort of what your mindset is like and your perspective on when you might want to put some risk on and enter into a trade?
Yeah. And that's a great question. Earnings gap ups, for instance, are some of my favorite trades, right? They gap up on good earnings, and that's like a sign to you that there is underlying demand. And if it's got a really nice technical chart or it's breaking out of a multi-week, multi-month base, and it's got good earnings, one of the things, a very simple setup might be buying the 5-minute opening range break, right? So the market opens, it has a 5-minute bar, that 5-minute bar closes. And then I'm looking to enter over that 5-minute high with my stop at the low of that 5-minute. Now that might not always be a successful trade, But as long as you're taking a, proper position size, and that's a topic on its own, 10% of my portfolio on a trade with 4.5% risk. If I'm wrong, I'm going to be losing 4.4 to 0.5% of my portfolio, right? Something manageable to overcome, right? Nothing life threatening, that you just, oh man, I just took a 10% hit. No, it's a very manageable loss, but it is a very repeatable setup. If you just study what earnings gap ups look like, continuation setups, just something that's gone up and gone sideways for 3 to 5 to 7 weeks and gives you your famous Bill O'Neill 3 weeks tight setup. And then just buying as you're breaking out of the range, right? In an already strong group, right? And it's just a continuation pattern. Now, oftentimes, the market is ever changing, right? Where we are within the market cycle. So trying to understand how long earnings winners can move for and what your entry tactic is depending on the market. Right? If the market's just ripping and roaring, a simple breakout will do. Right? If the market's a little bit choppy, maybe buying an undercut and rally where you just look at the daily and it comes into a level of support, maybe undercuts it, begins to rally, zoom in on the 5-minute, get a little bit more granular, take your entry as things are turning back up. Mm-hmm. As Lance would say, the right side of the V, mm-hmm. right? And he's somebody else who I've, learned something from another great and said, what is it that he does? And you get like this kind of capitulation into a prior level of support. Stock begins to turn up. You kind of get the right side of the V. And as it starts to turn up, you take that into a few green bars and then you set your stop at the low. And that low on the daily is a support level, mm-hmm. right? So a simple undercut and rally. Mm-hmm. And so entry tactics definitely change based on market environment, but, kind of learning those as time goes on, right? Not everything is going to be a perfect breakout. Not everything's going to be a perfect earnings gap up. And not everything's going to be a higher low on the daily where you just enter in right over prior day's high.
Yeah.
That is how I take most of my entries, right? I like breakouts, but you're not breaking out if you're buying it within yesterday's highs, right? It has to be above yesterday's highs, above yesterday's channel for it to be a quote unquote breakout. Mm-hmm. And even still, you could be buying over yesterday's highs, but it could still be at the lower part of the range as an undercut and rally. And you have to understand that the stock might still have to churn through a little bit of supply within that range to really be a breakout. But if you get the undercut and rally, maybe you can also be adding over the breakout level, right? So be increasing your quote unquote risk and you maybe increase your cost basis a little bit, but you're not really adding risk to the trade. You're just adding a little bit more size and maybe scooting up your stop a little bit. Mm-hmm. So
yeah. And I definitely want to talk about risk management because one of the things I think that's interesting that you've spoken about is that you will take one position. And so, how do you manage risk to make sure that you're, losing a manageable amount if the trade isn't favorable? And will you re-enter into the position? Will you try 3 tries and you're out kind of thing? How do you think about managing your risk? Do you try again the next day? Do you wait for the setup to try to play out all over again? How do you think about, risk management overall, but then how do you think about risk management for your style and what works best for you?
Yeah, I think that the simplest answer is really position sizing. Right? If I go and buy a breakout, but I have 50% of my portfolio in there with a 4% stop, right, I could be losing 2% of the whole account just on being wrong that one time. But I really do a good job and I implore everybody to position size properly, right? And use what Mark Minervini teaches called progressive exposure. So when I go and I'm sitting on a full 100% cash and the market gives me a follow through day off of a correction, I'm looking to buy that breakout or buy the higher low setup or the undercut and rally, depending on, my style, my technique of entry. And it'll be with a 10% portfolio position. And I don't ever really like my stops to be more than 7% away because then my timing would be off, right? If I have to widen out my stop that much. And if I felt like I did, I would size down even more, be a 5% position and then look to add later. One of the things that will happen is, the first 30 minutes of the day tend to be the most volatile. So, and I might be looking for a breakout over yesterday's highs where I buy that breakout and my stop will go to low of day. Could be 3% away, could be 4% away, depending on how volatile the name is. Another thing that people might need to consider is how much range does this particular stock have, right? A stock like NVIDIA moves 3.5%, 4% per day. You know, a small cap like BBAI is moving 12% per day. So if I'm buying a breakout over yesterday's highs, is my stop 10%? And if so, do I just need to maybe get a 5% portfolio position on versus an NVIDIA with a 3% risk? You can even get to a 20% position on. So, and then from there, obviously thinking about situational awareness. If I'm buying a NASDAQ stock, how is the NASDAQ looking on the day that I buy? Am I giving my stock the best opportunity to work when I buy? If the NASDAQ's getting beaten up and I'm buying a highly correlated market name, right? The likelihood that my stock has the best chance for success is going to happen when, at the very least, the NASDAQ's going up, right? And so trying to align my buys with what the underlying market that I'm trading is doing. So that's very important. And if I get stopped out, it's a manageable loss. And I'm absolutely willing to try it again. So if I buy a breakout over yesterday's highs from a clean technical pattern and they've got good fundamentals, and then I buy it and then I get stopped out at low of day, if I'm noticing at the end of the day, the market's really strong and closing towards the highs of the day and my stock has, you know, stopped me out at low of day, but then turns back around midday, you know, everybody comes back from lunch and, you know, that last 90 minutes of the day, you're either going to get a strong close or you're not. And so if you get that strong close and you break back over prior day high, I would be very comfortable taking that entry, right? And again, even if that means that the low of the day now is a little bit further down, that means either you change your position sizing a little bit, or you're cognizant of the fact that, you know, hey, low of day is a little bit, you know, further down. I'm still going to take the same size, but I know if it's a 5% stop and I'm taking 10% size, I'm now risking another 0.5% of my portfolio, right? So it's really being conscious of that. But if you believe that you're looking at stocks within a top group in a healthy market that have good fundamentals, that have a very nice technical chart, and all of my little boxes are checked, I'm very comfortable trying it again. And yeah, I probably do have like a 2 strikes and I'm out kind of deal on the same day with a particular name, because it might just be that I try the breakout and it doesn't work, and I try it again and it doesn't work, that the market's actually feeding me some clues as to what buying breakouts today might look like versus, you know, did that dip level, did today's lows match up with a moving average on the daily? And maybe it's better to be looking at that low and then the right side of the V kind of an entry, or should I still continue to stick with a breakout over prior day high? And the market's always giving you that feedback. So it's just being a good listener as to what it is that's working this week or this month.
Yeah. And based on the week or the month, you might have significantly stronger sectors, groups.
Absolutely.
How do you think about the rotation of what's working, what's not? You know, how much of what's working at the moment might influence your decision to stay in the stock versus start peeling some and taking profits? How do you think about the profit-taking part and watching what the market is doing and listening to the market kind of tell you when to take your profits? How does that work for you?
Yeah, that's another great question. And that's actually a question that I've tried to touch upon with Sam. You know, when I am viewing my own positioning and I take a breakout and it's working, and then the market invites me and shows me another great technical pattern and I take it and it's working, I'm really still only looking for 3-day to 5-day momentum bursts. And that's something that's taught by Pradeep. This is how stocks breaking out of strong technical patterns look. They make their move up, they consolidate, they get tight. When they're breaking out of that tightness, they go for 3 to 5 days, right? And my job as a trader is to get paid on some of that, right? I did my job. I scanned at night. I found my setup. I took my entry. It moved for 3 days, right? I'm trying to now improve my worst case scenario. So I sell some into that strength. And for me, I typically like selling half, right? I don't have a crystal ball, so I don't know what's going to come way down the road, right? But a great example was recently I bought Hings at 29, and then it goes and I'm trimming some at 37. Now, yes, do I wish I held the whole thing up to 70? That would be crystal ball talk, right? But I caught the move that I was hoping for, because that's really what trading is. It's something's tight. It's offering me low risk on my entry. It gave me a move to 37. I peeled half. And I love selling half because if it goes higher, mentally I can say I still have half. If it comes back and stops me out below a moving average, I'll say, at least I sold half, right? So like mentally, I can live with that. And then at that point, I like to just trail on an ascending moving average. And again, another great trader that I'm familiar with is Jeff Sun, and he likes to talk about extensions from the 50-day moving average. So if a stock moves, for instance, 4% per day, and now we're 28% above the 50-day moving average, I would say that that's 7 times its average daily range above the 50. And then I know, even if I'm down to half my position, I want to trim 20% of what I have left. And then you get 8 times extended from the 50 days. So you have another green day. I want to trim another 20% of what I have left. And then 9 times I trim another 20%. So trying to trim as much as I can into that strength. And then, part of me goes, if something goes parabolic, I start to think about the other side of the trade as a trader. But ideally, if you're in a company with really good fundamentals and you catch a parabolic move, trim off a portion that you're willing to say, hey, until I get a close below the 20-day simple moving average, I'm not leaving, right? I'm now hoping for a consolidation. And if it lasts a few weeks, a few months, it allows me to maybe add to that position later. But I want to keep a nice low cost basis with a trimmed up position to allow me to not feel angst over a 10, 15% pullback because I'm out 80% of my total position, right? I've done a good job of paying myself and treating this like a business. So selling into the initial push and then trimming some as you get extended from the 50-day moving average is a really good way to manage your profit taking. And then allowing the lagging indicator, which is a moving average, to say, if it's above the 20, doesn't matter what it's doing today, right? I'm trimmed, it's not extended from the 50, can't trim more. I'm only out half, but if it just stays above the 20, who cares, right? If it's a smaller cap that moves a little bit faster, maybe I use the 10-day. If it's NVIDIA and it's earned the right to use the 50, maybe I use the 50, right? And allowing the stock to dictate, if it's going to get trailed on the 50, on the 20, on the 10, if it's a faster mover. But making sure you're paying yourself.
Yeah, absolutely, which is a critical part of trading. You got to make sure that you're getting paid at the end of the day.
Yes.
And in terms of technical indicators, what are some of the moving averages and technical indicators that you really favor or that have a lot of influence on what you're looking at in making decisions?
Yeah, the only really thing that I use are just basically lagging, trailing moving averages, right? The 200 sets the objective picture. Is this thing in a bigger picture uptrend or not, right? The 50-day I really use for judging extensions away from, where current price is at to judge if I have to peel some more. And then the 10 and the 20 is usually what I use to just stay in the thing, right? If it's above the 10 and the 20, you just hang out. So just lagging moving averages. Again, I learned that from everybody's favorite trader, Christian. And it's just a very simple, objective way to say it's above. I'm not doing anything with it. So I don't like to use RSI or MACD or, Bollinger Bands or anything else per se to overcomplicate my own decision making, right? I want to just simplify everything as much as possible so that we don't have conflicting indicators. And then I have to now dig into my own soul and be like, is RSI lying to me? Is MACD lying to me? Should I just trail my moving averages? I don't want to get caught up in that. And I think the more you simplify it and the more you find what works for your personality and your daily routine and your life, I think is really important.
Awesome. Thank you so much.
Oh man, absolutely.
Yeah. And for the last part of our interview and our episode, I'd love to go through just a lightning round set of questions, if that's okay.
Yeah, absolutely.
So first one would be, what do you consider to be your greatest strength as a trader?
I personally think my greatest strength is my adaptability and my willingness to continue to learn. Although I might be profitable and I've done well almost over the last 5 years, it's recognizing when others are doing something that, intrigues me, and then being willing to set apart some time to continue to study, right? Although I am a profitable trader, it's going and still learning from someone like Lance, right? Even though I might say, I'm doing fine on my own, I don't need to learn anything else. No, still being open-minded to learning more.
What's one area of your trading that you hope to evolve even further?
Just mentally being comfortable with scalability, right? Being comfortable with pushing more size. And I truly believe that that's just a matter of where everybody is in their trading journey, right? As the larger portfolio you get, the more aggressive it might look like you're getting, but just doing more of the same, but with bigger size and being comfortable doing that.
And are there any areas of your trading that you're still working on to improve, particularly for this year, 2025?
Yeah, execution. I think that, every cent in the market, maybe not so much for a swing trader, but when you're really trying to put on big size, it's like making sure that you're doing that at the right spots and eliminating that sense of fear of missing out, right? Even sometimes I get that, like I saw a beautiful chart. I didn't have my eye on my alert box. So when my alert triggers and I set 6, 7, 8 alerts the night before and a few of them trigger at the same time, don't go and look at that chart that is now extended away from the lows of the day. It's up more than one average true range away from the lows, and just say, I got to get in, right? And so just like eliminating the FOMO and knowing that there's always another opportunity right around the corner.
Is there one myth or misperception do you think people have about the world of trading or the stock market in general?
We've all been told that only 10% of people succeed within trading. I think having perseverance, having that faith within yourself that it is doable, and that with enough studying the people who came before you and did, what it took to survive for 2 decades, and just being a copycat in kind of a way, right? And saying, I don't need to reinvent the wheel. The wheel's already been invented, and just kind of being willing to learn from the greats behind you.
What's the best piece of trading advice you ever got from another trader, someone more senior than you, about trading?
Never stop learning. Always be adaptable, and then focus on the things you can control. Don't focus on past results. Focus on the tomorrow, and do things even during your not trading day that would be conducive to better trading tomorrow. Whether it's get good sleep, eat a good meal, get some exercise in, have good awareness that, if you've got something going on in your personal life, to maybe pump the brakes within the market, because it's never going anywhere. Mm-hmm. So, and I've heard that from many of great traders, when there's something going on in your personal life, maybe just back up a moment and, just let your body settle, let your mind settle, and come back to the market with a fresh mind.
And if there's someone who's out there listening that's having a hard time with their trading, maybe they're going through a drawdown, just had a big loss, they're considering quitting trading, what advice would you give them in general?
Yeah, don't quit. Size down. Believe in yourself. Know that it can be done, and don't stop learning. You have to review those big losses, right? You have to review what it was that I did wrong. Was I oversized? Was I trading the market with a certain bias? Was I long bias on a group that was going down? Did I stay stubborn? Did I add to my loser? There are a lot of little nuances as to why you could have had a big drawdown that need to be studied. And the only real way to get better is to be honest with yourself and do that deep dive and answer the hard questions for yourself, right? I took a big loss, even though I had the best thesis ever, and I was on the right theme a year early with nuclear names. I ended up getting aggressive on CCJ well before the technicals aligned with my fundamentals, or should I say with my thesis, the technicals weren't aligned yet. And so I was still buying a stock that was below its 50, hugging the 200 effectively. And they ended up doing an offering. And if you're in an offering on something that's in an uptrend, it's pulling back to ascending support, but if you get an offering in a stock that's in a downtrend, there is no support. Mm-hmm. And so being early is still being wrong. And I had to do like that internalizing and learn that hard lesson for myself.
And so what would you say is maybe the lowest hanging fruit that a trader can do in order to improve their trading that maybe they're not even thinking of?
I mean, as silly as it might sound, it's get good sleep, right? That is the lowest hanging fruit, and focus on the things you can control, right? If you don't get good sleep, for instance, how are you going to come to the market with a clear mind? Mm-hmm. And then do the homework the night before. The best ideas don't just typically, unless you're a day trader, right? Some of the best ideas can sprout up midday, but some of my very best ideas come from the night before, mm-hmm. right? If doing that homework and figuring out where's that money going, where's that money leaving, and seeing it for yourself within multiple charts, gaining that conviction that you understand what it is that you're seeing.
What's one thing that you do outside of trading that you think helps you as a trader?
I've been trying to play a little bit more pickleball with my fiance. So being a bit more active, right? Getting out of the desk, right? I try to distract myself with friends, with my family, with my dogs, who I love dearly. So just decompressing and kind of stepping away from the market. And again, realizing that the market's always going to be there, right? When it's time to scan, you take your 30 minutes in the evening and figure out what's going on. But just knowing when it's time to kind of rest your eyes and back off, and when it's time to kind of step on the gas.
And how important is it to have a great support system? You mentioned fiance, dogs, family. How important is that to have as a trader rather than just being in isolation, just trading all day, every day?
Yeah, you need a great support system, right? There's absolutely nothing about trading that is easy until you have done all the hard work on the front end. But in the meantime, while you're still learning, while you're still studying, while you might be struggling, while you're not recognizing the market change, having people to lift you up, having people to say, don't worry about it. It's going to be fine. Just keep your head in the game. Don't worry about it. Everything's going to be all right. And I've had that in my career. I've had great mentors along the way, guys in IU, personally, other traders, and then surrounding yourself with a pod of traders, whether it be like-minded people and better still, people who aren't like-minded. So you can get the other side of, the coin, where you might say, this is a great setup. And then you have somebody be able to explain themselves why it might not be, right? Thoroughly. And so, having that great pod around you is very important, and having a strong support, group, whether it's your family or your loved one or even your dogs, right? And it's like, they're always there for you. And, just being able to just kind of step away and know that, hey, no matter what's going on, I've got somebody that's dependent on me and totally unrelated from trading. And, that is very important.
Yeah, absolutely. Great advice. Great answer. And last question for those listening who would love to learn more about you or how you trade, maybe even contact you. How can they do so?
Yeah, I'm on Twitter, Real Simple Ariel. I'm also in IU, and, I'm always dealing with and talking to the traders in there, and anybody who reaches out to me, DMs, I try my best to make sure I'm getting back to people diligently. And again, on X and Real Simple Ariel, it's a very simple way to get in touch with me.
Awesome. Well, Ariel, thank you so much for being here and doing this episode. Long time coming. Really, really glad we got to do this. Thank you so much.
I appreciate it. Yeah, thank you.
We hope you enjoyed this episode of The Trader's Journey. We have additional episodes we believe you might also like, so don't forget to subscribe. You'll be notified of upcoming releases the moment they're available. Thanks for tuning in.